to group the expenditures in every other calendar year. This was to maximize state aid purposes. I won't get into that unless you really have time. But that's worked out very well. And between those two things, the lower interest rates and maximizing state aid allowed the issue to be paid off early. So you can see originally the 21 issue, I'll back up. The original referendum issue issued in 17 was scheduled to be paid off in 2037. After the refinancing in 21, it was scheduled to be paid off in 34. And you can see that those payments in 33, 34 are just stars because we've defeased those, and we also defeased a portion of the 32 issue. You'll see the remainder of $6.75 million. What a defeasance is, the district levies in advance of the payment. Those additional dollars that are levied are deposited into an escrow account and assigned to certain maturities in the future, and then on the call date, which is in April 1 of 28, the escrow agent will pay off those maturities. So legally, you've met your obligation. Those are legally paid, even though the bonds are still outstanding until 4/1/28. And then actually those two maturities, the 5.58 and the 6.71, and part of the 11.2 we'll be talking about in reference to the defeasance a little bit later on in the agenda. So what's going to be happening is that the debt's going to be paid off much earlier than anticipated at the time of the referendum, which, again, all interest savings on this type of debt in Fund 39 is taxpayer savings. District can't reallocate that levy authority for any other purpose. So the district just has one referendum-approved issue, and we'll talk more about that on a later agenda item in terms of the actual payoff projection. Then there is Fund 38 debt, which is non-referendum debt. And we have older issues on here that have been paid. So if you don't see any, like in the qualified school construction bonds, that was a federal program that was low to no interest to the district, took advantage. That's been paid off. The district also did a $10.5 million issue that was paid off just a year ago, 4/1/25. They had an energy efficiency exemption, and part of that was energy efficiency exemption, which is a little different. So in Fund 38 debt, you most commonly pay it with your existing revenues within Fund 10, which is your operational budget. So you do your revenue limit formula. If you have a debt payment that was non-referendum, you had to allocate dollars from within that revenue limit to make that debt payment. The energy efficiency exemption portion of that issue, that was outside of revenue. There was a program that allowed districts for energy efficiency projects to issue debt without going to referendum and got additional levy authority within the revenue limit to make that payment. Once that payment, as this one has been completed, that authority goes away for that specific portion of Fund 38. And I think it's only about 395 years until that program comes back online. So we'll be discussing that at a later date. So those issues are paid off. If you go to the next page, there are a couple outstanding issues. One is a state trust fund loan, which actually the district will be, I think, made its last payment on that. So that's actually been paid. That was part of this year's budget, but that issue is now completely paid. So the only remaining issue of Fund 38 debt is a $3.97 million promissory note that was issued in 2018, and the district will have two more payments remaining. Now the issue is callable as of 4/1/26, so if the district would have funds within Fund 10, you say you had a good year, had a surplus, or had funds available, you thought a good use would be to prepay that, you could pay off those last two maturities. Simply, bond counsel would draft a call notice. That call notice will go out to bondholders, and 30 days later, you can make the payment, and that debt could be gone. Or you can just pay it within the scheduled time frame. you can see the interest associated with it is relatively small, so there's not a great deal of interest savings. There is some, I don't want to minimize it, but it's relatively small in the big picture of the budget. But the district does have that option at this point, either to continue payments as scheduled or make the decision to prepay one or both of those maturities prior to their payment dates. So, and once those are completed, the district, in comparison to other districts, and the last couple of pages are just summary pages for the Fund 38. Relative to other districts, the debt profile is very good. Rapid repayment of debt. The debt's going to be going away fairly quickly. From a rating standpoint, that's always a positive as well. So.
That $3.9 million you were just talking about, that the number reminds me that was the addition to a Rockfield School, I recall. So it'll be nice to get that off the books after all these years.
And one thing I did forget to mention, once the dollars going for that payment, once that payment goes away, those dollars are part of your operating budget, and those dollars can be then reallocated somewhere else in the budget. Since they're being drawn from your revenue limit, they'll remain in your revenue limit, and then you can choose how to use them going forward.
So this debt works a little bit different than like a mortgage or something. So when we pay additional on the principal, you said the amount goes into escrow. What happened, like when we prepay our mortgage, the
Sure.
principal goes down. So what happens to that money that's in escrow?
So when the debt is originally issued, there's a call date associated with it typically. And this is done because the buyers of the bonds want some comfort that they'll be able to hold the bonds for a certain period of time. And then any maturities, if you go back to, it's probably easier to see on page 1, the Fund 39 issue, the $81.795 million taxable issue. Those maturities in that box, those are the callable ones, and you can see the call date is 4/1/28. So those are the maturities prior to that are set.
Okay.
You can't call them, you can't really prepay them. You can put money into an escrow account, and the escrow agent can make those payments. But the structure is that there needs to be some assurances for the bondholders that they're going to be able to hold on to those bonds. They're investing in them for a purpose. Now they may buy or sell them over time, but when they initially buy them, and so they want some comfort that those bonds are going to be out there for a period of time. You can sell bonds without a call provision, but you will pay a higher rate, because that's something in the issuer, or in this case the district's advantage, to have the bonds that can be prepaid at any time or refinanced at any time. So that's an advantage to you, a disadvantage to the buyers, and so because of that they'd want to require a higher rate on the bonds at the time of the initial sale. So the kind of setting a call date out into the future is kind of a compromise. Mm-hmm. And so, and then the rest of your question in terms of the dollars that go into the escrow, they are invested into government securities. That's all you can invest in. There was a time, especially back when these bonds were sold in 21, you weren't earning anything in your escrow account because the government securities weren't providing much. But currently, anything like the defeasance we'll talk about later, you're getting a pretty good return on those. So they're not sitting there at 0%. And those investments in the escrow are locked in at the time the escrow is funded, when the dollars go in there. So you know exactly what the dollar is going to be available to prepay debt. So when we later we'll talk about the defeasance, we know exactly how much of the bonds we can defease. And again, in the district's case, that's considered paid.
Okay. So not only is paying it off earlier good for our principal, we actually earn money on the district earns money on the amount that's in escrow.
Correct. And that's factored in to pay down additional debt.
Okay.
And again, that depends on the interest rate environment to how impactful that is. But right now, it's not it definitely adds to the savings.
Okay. Thank you.
Are you going to get into state aid later when we talk about the defeasance?
Well, I could probably touch that now. So
just a quick.
I hinted towards it.
I know.
We want them to come back for a second meeting, so.
Yeah, you'll,
We did in one of our other series talk about it briefly.
Right.
So Sarah Vieira from CISA was one of the other
Okay.
presentations that we had. So she slightly talked about it, but
So-
you can talk more about like the purpose of why we do that
Yeah,
every other
so
year.
when we refinanced again in '21, and you can see there's some years there's no payments. How state aid works is they look at your fiscal year expenditures, the state does. They look at your property value you have behind each student, and those are the main factors to determine how much state aid they will provide back towards the district. And there's 3 levels: there's the primary, secondary, and the tertiary. And the tertiary one is the key, because if your property value is such that it's too high, you actually lose aid for every. So, for example, if you're negative 35% tertiary, every dollar you spend at that level, you lose 35 cents in state aid. Up to a point, because you only can lose 15% of your previous year's aid. So by grouping the expenditures into 1 year, yes, you're still negative tertiary aid, but your expenditure goes beyond the point you're going to lose your 15%. So any expenditure beyond that, $1 costs you $1 versus $1.35. And that's the reason for the grouping of the expenditures in the issue. It's a little bit unique. You have to be just situated just right. We've done it with a few other districts, Wauwatosa, Pewaukee, Grafton, I think are the 4 that kind of fit at the time. And it can your percentage of negative tertiary can vary. Now with the state not putting money into the aid pot this last biennium budget, it kind of pushed, some districts further into negative tertiary aid. But other factors, Pewaukee went through a big growth spurt, and so their valuation per member dropped because they had such an influx of new students, and you're dividing by the same tax base, they became less negative, so the benefit was lessened in some years. Now they're losing kids again. So it kind of ebbs and flows, but we don't have a firm number. We've never really gone back, and we'd have to kind of recreate everything again based on the old schedule and different things. But we're certain that it saved millions of dollars in state aid, which is not reflected in the numbers we'll be showing a little bit later on. And again, more state aid means less tax revenue needed, so it's taxpayer savings. Is that enough, or?
yeah, that's enough, I think. So correct me if I'm wrong, but to put it another way, if you have a lot of debt, the state thinks you don't need so much aid.
If you pay a lot of debt, so your payments,
Okay.
the state goes off of what your previous year expenditures are. So if your previous year expenditures stay here, they're going to say you don't need as much money. But because 1 year we have a large amount, then we have 0, because it gets recalculated every year. Then they'll say you're spending way less this year. And then we go back up, and then it doesn't affect it long term as much.
So what you're doing is we're trying to eliminate the expenditures to push you into that negative tertiary where you lose aid. So then your aid goes back up because doesn't work out perfectly every year, but the goal is to not have any negative aid, so you get to retain all of your secondary. So, because what happens when you have negative tertiary, it drops down to the secondary level and subtracts from there. You have this negative, it needs to be offset somewhere, and it's offset at the secondary level. So if you can eliminate the negative tertiary aid, you get to retain all your secondary aid. And then the following year, because your aid is actually higher, you only can lose 15% of that higher number, which kind of protects you. And then we spend way beyond the 15, the level that would cause you to lose the 15% the following year. So any dollars above that, again, $1 costs you $1. So
Very good. This is more of accounting math than engineering math, which is interesting. Tom?
Regarding the Fund 38, 3.97 million, promissory note from 2018. Is there a reason that wasn't refinanced when rates dropped to 1 to 2%?
Because the, I remember we discussed that the savings was relatively small and in the combination, we looked at putting it with the other one, but the benefit was so small that for that particular issue that we just kind of kept it aside. So.
Okay.
And there's costs to refinance, so that was configured into
Yeah.
the savings.
Yeah, that would eat into any savings that you might
Right.
have.
Yeah, I mean, when you're looking at the interest, it's not only just your coupon, it's the interest cost. So those two maturities, you're looking at $28,000 of interest that you could have, those are the only two maturities you could have refinanced. And when you're looking at $28,000 of interest, how much would you have to save to offset the additional costs associated with refinance? It's kind of like a mortgage. You need a certain spread
Yeah.
to justify the closing costs and things
Right,
like
but
that.
could we have refinanced 2022 and 2023 and 2024 payments to cut the interest in half?
No.
No.
Yeah, we
No.
looked at all the Fund 38 and the cost associated with it and the benefit just wasn't there.
Okay, thank you.
Good question. Okay,